virtually 100% odds now in the market of a July rate cut. Does that seem right?
Yeah, I'm not sure it's virtual, Sarah. I think it's actual. It really is 100. That's the number, as I read it from our Thomson Reuters machine there. And then I think you're up to 80 for a second cut in September and 65 for a third cut by December. So there is a lot of rate cutting built into this economy and into this market. And I think the idea certainly for July is it's kind of like the economy's rate cut to lose. And I think the way I think about that is you have to have a lot of strength in the data. And you didn't get it this morning, by the way. You got some in claims, but certainly not in the Philly Fed. Leading indicators missing by a tenth. That all goes into a framework of, OK, we're missing by enough. There's not enough strength. There it is. I'm sorry, I misspoke. 90 for September. That is virtual 100, Sarah. I guess in my book, I don't know how you count it, but anyway.
Virtual certainty, how about that?
Right, virtual certainty, right? And then you have this road, I say, to the cut, which is you have the Xi and Trump meeting, you've got the June jobs report in July, and then you have GDP and a bunch of other data leading up to that rate meeting at the end of July.
So, Mike, what do you make of the exuberant market reaction here to something that was already priced into the market before Powell?
I think it was largely priced in the form of hope. I think Powell maybe came a little bit closer to the market than some people thought he might. The way I read it, though, is the one reason you would have been very, very nervous, and a lot of people were in equity land very, very nervous about the markets coming into this meeting, was the extreme drop in Treasury yields, right? If the Fed is going to lower rates on the short end, and you're no longer perhaps going to have that upside-down yield curve, you become incrementally less worried about the fact that yields are where they are. And stocks do very well, let's remember, in a 2% world. 2% growth, 2% Treasury yields, somewhat close to 2% inflation if we're lucky. That's just fine. And I think the reason it's just fine is because corporate bond spreads have remained relatively tight. So the cost of corporate borrowing is very low. We're back to January 2018 levels on investment-grade corporate yields. It's boring, but the math says that supports where stocks are here. And I can't emphasize enough how defensive and negative people were. Much to my surprise, we got this 5% bounce. People didn't get happy about it going into this week.
So are we in the mode now where bad news on the economy is good news for the markets because it just furthers the case of a rate cut?
That's what I don't think. I think once you think you're getting the cut, I don't think you necessarily want to see the economy start to slide further. So that's the trick here. And I don't know also how much slack there is, so to speak, in the line to get indexes higher on just the strength of what we're getting from the Fed and just to burn off this negative sentiment, simply because earnings look like they're kind of flatlining at the moment.
Although expectations for the back half of the year are still good. And it's rare that you get a true cut cycle and earnings that recover from lower levels.
Without a doubt, and that's why I'm viewing it now as there's lots of room for downward revision for the second half earnings estimates. I think that's going to be the crux at some point once we get past the macro stuff.
It sort of raises the question, Steve. I mean, if there's some sort of trade truce or good news out of G20 next week, if the economic data doesn't come in all that bad, does the Fed still cut? I mean, has it backed itself into a corner here?
So, Sarah, I think your phrase there, all that bad, is the one we have to think about. I think it has to be pretty good for the Fed not to cut. I think it has to suggest that, you've got, if you're back up on jobs towards 200,000, and by the way, when we think about the surprise factor for the market this morning, when you look at the factors that maybe are buoying the market, you had 8 officials now forecasting a cut. 7 of them wanted 2 cuts. Plus, I don't know, Sarah, you remember when I asked the chairman, is it just China? If they do a deal, he says, nah, it's really kind of more than that. And I think that was something the market liked here. So they could do a deal with China, and you could still get your rate cut. The only thing I worry about, and this is more of a Santoli thing, I just want to know, I worry about what Mike is doing out there, is, careful a little bit what you wish for. If you get the weakening of the economy, there's the other surprises there. But if you get the weakening of the economy out there, I don't know how wonderful stocks are going to feel if some of these numbers start coming into the downside.
No, that's exactly right, because you already have revalued the market up toward the higher end of its recent range, and it's not like you're priced for something like that. I really do think the market, and you look at this with the way that, the 10 and 30-year yields have stayed relatively high, they're kind of saying 50 basis points might do the trick and essentially inoculate the economy against a further slide. But we don't know if it's going to work.
Steve, last point on a more political level. People are joking that Powell's job is safe now, and he didn't even have to cut. Is it?
You never know, Carl. I mean, that's well outside my area of expertise to predict what the president's going to do, what he's thinking, and his read of the Federal Reserve Act as to whether or not he has the authority to even fire the chair. I think that it would. Here's the question you want to ask yourself, okay? And I hope it's not too long an answer, but very quickly. The Federal Reserve Act is silent as to the ability of the president to fire the chair. So Peter Conti-Brown from Wharton says what protects the chair is politics and the markets. So ask yourself this question. Actually, Santoli's got a better answer. If the President Trump thinks the market will freak if he fires Powell, then Powell's protected, but only in that circumstance.